Welcome to Inside Asia, an SEB podcast about Asia's economies and financial markets. My name is Fredrik Hähnel. I am head of Asia for SEB and general manager of SEB Singapore. And with me on this pod, I have Sean Yokota, head of markets for SEB Asia. Hi, Sean.
Hi, Fredrik. Good to be back.
Yeah, nice to be back after summer holidays. And we will today mainly talk about the Chinese economy as there's so much happening right now. But first, Sean, what is the latest in Asian financial markets?
Two big topics right now. One is the usual US 10-year yield, where it just keeps going higher and higher and making new highs. And it's not based on higher inflation, but on real interest rates rising. And this is hurting the US economy, of course, but it's also hurting Asian financial markets, as Asia is always linked to the US economy and to the US dollar and to the US monetary policy. So this is an ongoing issue that whenever US sneezes, Asia catches a cold as well. And this is something that China is working on longer term to start to decouple from the US. The second thing is, of course, the China related risk, especially with the property market in mind. We were talking about Evergrande for a long time, having problems and defaulting on its debt, but now Country Garden has joined this. And it's gotten bad to the effect that it's starting to spread to other places. So we're seeing lower Chinese stock markets, and then now a weaker renminbi where the central bank has had to intervene, and the CNH interest rates are rising because of this. What about you, Frederick?
I think a comment on this on the property sector. I read somewhere that Evergrande's reported losses in 2021 and 2022 that we now finally got. They amount to 812 billion renminbi, which is more than the total earnings that Evergrande made since it was established in 1996. So this is quite substantial numbers that we're looking at. No, but what have I been thinking about or reading about recently? Of course, the BRICS meeting has been quite central, which took part in South Africa this week. The fact that Xi Jinping has only done 2 trips abroad this year, one was to Russia and one was to South Africa for the BRICS meeting, is quite interesting. So while the economy that you mentioned is in a lot of stress in China and geopolitical tensions are on the rise, the Chinese president is working hard to align with a developing world to create a counterbalance to the US-led world order and also trying to become sort of a leader of the global south. This is something that we can come back to in today's pod if time allows, but I think that's quite interesting.
Yeah, so today let's talk about the economy and its problems that's causing global financial markets, and then we'll follow up with the BRICS. So if we kick off with the economy, why don't you start off, Frederick?
Sure. It's been a lot of numbers that have been published over the summer and also more recently. And it seems increasingly that China's expected reopening boom has fizzled out extremely quickly. And we have recently had a flurry of bad news and political changes. And of course, in terms of political changes, I'm thinking of the Chinese foreign minister who was fired very suddenly. But let me see if I can summarize what has happened over the summer. We had the Chinese exports numbers coming out that, falling 14.5% year on year. We had import numbers falling 12.4%. We had foreign direct investments number very weak. They came in at only 4.9 billion US dollars in the second quarter, which is down 87% from the same quarter a year ago, and that's the lowest since records began in 1998. So they're very, very weak, these numbers. You look at inbound private equity flows; they were the lowest in 10 years. If you look at aggregated, capital markets flows in the bonds and equity markets from abroad, they actually increased in July when the market started to bet on more stimulus from China, but they've all been reversed since then. Retail sales, the way we usually measure consumption, grew by only 3.1%, a very low number, and the economy grew by 0.8% between Q2 and Q1. On top of all this, of course, we saw that China fell into deflation in July, something we can talk a little bit about. And China stopped publishing youth employment data. I don't think is ever good when a country stops publishing data. It usually doesn't mean that they look good. And then, of course, we had all these defaults among the property developers. You alluded a little bit to that in the introduction. Now, some two-thirds of all the private property developers in China have actually defaulted on their debt in one way or another. We have trust companies, investment products that have also defaulted. Property prices seem to have fallen quite a lot in second and third tier cities. So, it starts to look more and more like this is not a cyclical downturn that can be easily reversed, but rather more of a structural downturn that so many economists have been warning about. Would you agree, Sean?
Yeah, but just listening to you, it sounds like a very depressing story. But yeah, let's go to the structural aspects. But I think this is all stemming from the top leader's message that instead of focusing on the past, it was growth and liberalization and reform. Now it's clearly the focus is national security. You see it from what the government officials are saying and in domestic media. It's the priority is clearly national security. So this has two implications. Of course, if it's security, we see this US China tensions growing, and then China wants to reduce its reliance on the US. So, of course, exports would go down, and China would want to grow on its smaller engine, which is consumption. But of course, that's a small engine to be running on. And then the second one that the government's focusing on, I think, is on cleaning house, especially in certain industries that benefited and gained too much power during liberalization. And so we've seen it started with consumer internet. You saw what happened to Alibaba and Jack Ma. We also saw things like in the private education system. Those are like the tutoring classes that kids go to after school to get ahead. That got shut down all of a sudden. And then now it's the property sector, which, in the 70s, the Chinese property market was controlled 100% by the government. And then it just privatized all of a sudden. And those guys have definitely benefited, but they've also need to pay a price if their investment decisions were bad.
Yeah, and I think that the private sector is quite interesting to follow now going forward, because we've seen much softer signals from the leaders, right, supporting the tech giants a little bit more, at least verbally. And I think one thing to look out for during the fall of the year is the third plenum of the current party congress, which takes place in October, if I remember correctly, and that's usually a kind of forum where new strong signals on reforms, etc., can be communicated. So we'll see if we get a little bit more of that supporting the private economy and more reforms going forward. But should we come back to some of these things that you mentioned here, Sean, and why don't we start with what everyone is talking about these days, China's property sector and the financial risk, and dig a little bit deeper into it. I mean, this is quite important because, as we've said, I think in earlier podcasts, the property sector in China makes up around some 25 to 30% of the economy, and that's much higher than other economies. I read this morning actually that China's debt related to the property sector has gone from around 16% to GDP around 2008 in the financial crisis to topping way above 50% a few years ago, and it's come down a little bit since then. So this is of course quite big, and we always talk about the fact that Chinese savings are mainly in properties. So you would have wealth effects when property prices go down. uh, we know that there are so many different numbers, but some 70 million flats or so, too many, have been built in China. They're not needed. No one lives there. It's just an investment, and the population is shrinking. So this is quite interesting, and as you mentioned, Country Garden missed on its coupon payments on the US dollar bonds. We talked about the shadow banking sector that's also defaulted a little bit. How worried should we be, in your view, that this turns into a financial crisis that over time leads to even lower growth? I mean, that would be very important for the world, considering that China stood for some 40% of the contribution to global GDP growth in the past 10 years or so. How worried are you that this could turn into a financial crisis or even an economic recession for China?
I am very worried because China right now is thinking that it could perform surgery and kind of fix certain parts and not actually hurt the entire patient. But I mean, but all this really just goes back to the debt issue, which is at now 320% of GDP. So just to kind of put that number in perspective, so about 20 years ago, it was around 100% of GDP, which means that in order for the Chinese economy to grow $1, it just had it just had to borrow $1 to create $1 of growth. But now it's gotten to the point where the economy is so inefficient that you have to have over $3 to generate $1 of growth. So you just need more debt to make a little bit of growth. And it just tells you that the Chinese economy needs reform in order to grow long term. So this is where um, they don't want to do short term stimulus, issue more debt, and get the economy growing again because it's an unsustainable process. And if you keep on doing that, you might have to have a bailout and you might have to go to IMF. And it's at a time when China's trying to become independent of the US. So I think it needs to kind of get this short term pain into the system to reform so that it doesn't have to rely on things like the IMF in the future. So this is kind of a process of now I think they're trying to get the private developers to fail or they have to make up for the pain. And they're just hoping that the private guys suffer. They're still trying to protect the public state-owned enterprise developers such as China Vanke, and so that the private guys would give up their land and default and sell them back to the public developers. So they're trying to kind of distinguish the public and the private. But I think, once China Vanke or these public developers start to get hurt from a bigger protracted slowdown in the housing market, I think that's when they really have to step back in. But I think for now, they're just hoping that the private guys get hurt and it doesn't hurt like the bigger things like the currency market or the stock market. But as you see it, it's already starting to spread. So this is a bit worrying.
I mean, if we are talking about uh, continued here deflationary pressure, balance sheet recession taking its grip on China's economy, um, considering that the rest of the world, the large parts of the world at least, are struggling with inflation at the moment, could we look at factory prices in China. They are clearly negative, and then we were very close to, or we actually had a bit of deflation in the July numbers. Could a deflationary impulse be something positive for the rest of the world at this, in this case?
It is for the short term, and we just have to divide the short term and the long term. So for the short term, it is positive when prices go down, especially as this supply chain bottlenecks that we had that were pushing up prices, that gets alleviated and pushes down global prices. And I think if you look at commodities, things like copper prices are going down because of the slowdown in China, and that can be positive for overall global growth. But I think in the end, what's happening in the US is not just the goods price inflation, but a service price, which is dictated by the US labor market. So, from that point of view, Chinese deflation isn't going to slow down. Then you kind of look at the longer term effect. This is happening because the Chinese economy is weak. And from that, a weak China long term is not good for anybody in the world. So, I don't think it's going to help out so much.
Yeah, and the big question here is, of course, why, at least if you look at markets, they're kind of asking themselves, why isn't Beijing stepping in to stimulate more? But I think one other question is, of course, what could Beijing do at this juncture to stimulate and boost the confidence of the economy? I would argue that even if China does manage to restructure the developers and create stability in the trust sector, etc., there will be a huge hangover for China for the coming, not 1 or 2 years, but rather potentially 10, 20 years or more. One has to remember, that the credit expansion that we saw in China after the financial crisis up until recently is arguably the biggest increase in credits that we've seen in the history of economics. And if I just compare, everyone talks about could we see Japan scenario here for China, And I spoke recently to a common friend of ours who's Japanese, who told me that his dad's house in Japan, the price for that house in the market is still below what he bought it for at the end of the 1980s, before the crash in Japan. Would you agree that there are signs that we could see this kind of a scenario in front of us for 10, 20 years, and what can the government do to restore some confidence here?
From the Chinese government officials' point of view, I think they've studied two things very well. One is the collapse of the Soviet Union, so they know that's something that they don't want to repeat. And the second one is the Japanese bubble breaking and the 30 years of deflation. So those two things, I think, they know inside out, and it's something that they want to avoid. And so from the Japan debt deflation point of view, you do have to counter with a big fiscal stimulus to avoid deflation. So that is something I think they will do if they ever end up in that situation. But I mean, overall, just kind of thinking of what what can they do? As you said, there isn't much for now. They basically have to readjust the economy and go through some pain. So I think one good thing they could really do that they haven't is start to open up the tech sector again. Um, Let these guys start to develop their own technology. It's bottom up kind of growth. It gets a lot of young people employed. So that's something they could do, which they haven't done because of this focus on national security. Um, Another thing that we're looking for is they have two words that they always focus on. One is targeted, and the other one is incremental growth, and they keep on repeating that. So unless those two words change, they're not going to do a 180-degree shift in policy. And then the final thing that we're looking for is kind of a repeat of the exit of zero COVID strategy. So for a long time, everyone's wondering why they're sticking to it, and they just stuck to it. And what caused it to change? Well, we had protests in Shanghai, we had protests in Beijing, we had protests in Nanjing. That was enough to change Xi Jinping's mind. So this time, so far, we saw a small protest in Beijing over the default of some of these trust products. So it's kind of started, but it's still too early. So I think we have to still wait.
I think on your comment there on the tech sector, of course, one should also remember or mention the huge Chinese investments in the tech, environmental tech sector, if you will, or clean tech sector. And another number that I saw the other day is, China has invested in the past 19 months. China has invested more in solar panels all around China than the EU has done on a total basis since it started. And China is very much in the lead there. We talked about a new vehicle, new energy vehicles in one of the past pods as well. How China's been very successful there. So there's a lot of good things there as well. And I just want to mention myself on this comparison with Japan. There are several things that are very much similar. There are also other things that are different. One of them, of course, is that you will see probably a continued urbanization in China. It's not even close to being at where it sort of probably will end according to at least to China's own plans. But could we continue to say something about the currency as well? It's weakened quite a lot recently. You mentioned in the beginning that they're trying to stop the RMB from depreciating too quickly. I think you said to me before the BRICS meeting, there's no way it's going to weaken during the BRICS meeting. They will make sure, and they did step into the offshore market, right, the CNH market, and ask the Chinese banks to buy up the CNH in the offshore market, and decrease the liquidity as a way of making it more expensive to bet against the Chinese currency. But what is your view of the currency from here? Will they succeed in controlling this?
As you get past this BRICS week, where Xi Jinping has to kind of save face in front of everybody, it'll be stable. But after that, I think the pressure is for the currency to weaken beyond this. It's right now around 730. I think it can go above 740. And there are a couple things. One is that the dollar is stronger because of the rise in the U.S. yields, and the U.S. economy is actually relatively strong right now. So there's nothing China can do to counter that. And so we're just watching to see if PBOC it has a playbook on how to fight weaker currency, and it's doing that play by play. So first, it starts to set the daily fixing or the daily renminbi rate. And in China, like compared to what PBOC set, you can only move 2% weaker in a day. So they make that stronger to prevent it from weakening at a rapid pace. So they did that first step, and but it's not really working that well. So then they moved to step two, which is to squeeze the CNH offshore market by taking liquidity out, pushing up interest rates. So then if you have higher rates on CNH, it's more attractive for you to buy CNH. So they started that late last week, and that's worked a bit. Then like the markets kind of go back and forth trying to test out how strong the resolve is for PBOC. So I think the trend is still for a weakening currency. And then at the end, you get these capital controls that are put in place to fight a weaker renminbi. And so far, we haven't seen that yet. But if this trend continues, that's what we're worried about next. But for China, I think this weaker renminbi is a bit of a problem because if you want to attract more foreigners or if you want to attract confidence in China and the alliances that it's trying to form, you can't have a weakening currency. It just makes you look weaker. So I think that's something they really want to work on.
Yeah, exactly. And yeah, like you say, weakening currency is negative for investment flows. And then we did see not because of this primarily, but as I mentioned in the beginning, a very weak foreign direct investment numbers in China. But I also want to mention that very recently the State Council actually issued an opinion document on this subject with 24 points on how to improve the environment for foreign investors into China. So they're clearly seeing this as a problem and trying to sort of show the rest of the world that now after COVID is over and everything that we are really open for business. And of course, the document as such is a good sign. It has met many of the foreign countries' chambers of commerce's in China requirements over many years. I saw that the Japanese Chamber of Commerce, for example, said that basically everything we've complained about over the last number of years were met in this document. And this document talks about enhancing competition with local counterparts, the safeguarding the rights of foreign companies in, for example, public tenders and that kind of situations. It talks about simplifying visa restrictions, improving tax support, giving lower taxes for foreign companies investing in the western parts of China, and a lot of other things. So I think that's quite interesting and positive. But of course, the question is, will it be enough to turn the tide? And I don't know what you think, Sean, but in my view, with the current geopolitical situation, I believe that China is probably underestimating the headwinds and from among foreign companies that are now turning to other markets. And I think until foreign companies see some real positive implementations of these rules, I'm not sure this will help too much. The tide has really already turned for at least some companies. I mean, one should be careful with viewing all foreign companies as one. There are many foreign companies that still see a fantastic and interesting market in China going forward and keep investing. But on a general basis, I would say that foreign companies, many of them see better risk-weighted returns in other markets right now, such as, for example, India and Southeast Asia, and they may not see that these geopolitical risks will decrease anytime soon.
How about things like copyright and how much intellectual property you need to transfer to domestic China? That's always been a concern for corporate clients. Has that been addressed?
Yeah, I think that's changed quite a lot. I mean, I have a very long perspective of this since I started coming to China in the early 90s. And of course, it's a very different situation today. First of all, the rules and regulations are much stricter, and they're actually pretty good. It's more a matter of implementation that has also improved, but it differs between provinces. And the other thing is, of course, that China has opened up for wholly owned full ownership, so to speak, for foreigners to have wholly owned companies in China in many more sectors where they can then, they're not forced to transfer technology knowledge, etc. But it's all about implementation going forward, I think.
The next question that kind of leads me from here is that in order to attract more FDI, is this what we're doing with something like BRICS? That in order to attract not Western companies, but to companies from other parts of the world, that they are doing this to attract FDI into China from the rest of the world. What do you think about that one?
To a certain extent, I think, although I think this is a much bigger issue for China. But there were some numbers that were published earlier. I think it was this week that were quite interesting. They showed that if you look at all the developing countries of the world, I think the UN says there are 152 developing countries, and you look at all of those within that category that are within China's Belt and Road Initiative program, the combined exports from China to these markets for the first time until from the start of this year until now, for the first time ever, they actually exceeded China's exports to the U.S., Europe, and Japan combined. So I think when you look at these export numbers and investment numbers I mentioned in the beginning, I do think that China views these markets. It's not going to get easier to do business with the West and their allies, and they clearly see that the U.S. is more and more aligning with with Japan and Korea in this part of the world. So I think that China sees this, that the future battle, so if you will be between China and the West, not the least, will be who will win the developing world, who will win in these emerging markets. And I think China clearly sees that that's where they will have the future, export markets, and also try to attract investments from this part of the world. So I find that quite interesting. And clearly China is worried about what's happening. The investment ban we've seen in the U.S. now. Technology companies are not allowed to in certain sectors to invest in China anymore. Biden arranged this meeting with Korea and Japan, the first triangular meeting between the three of them ever outside a bigger forum. They're talking about setting up a NATO office in Japan to cover Asia, etc. So I think China is clearly worried about this development and clearly trying to align the developing world around it. And I think that's sort of more what's behind the BRICS meeting and their ambitions with it.
Well, let's go deeper into the BRICS and the meeting that's going on in South Africa now. Do you want to just give a quick background on what is BRICS and what was the purpose?
Sure. I mean, if we start by defining it, it stands for Brazil, Russia, India, China, and South Africa. It started in 2001 as a actually Goldman Sachs marketing gimmick when some partners looked at the big economies outside the G7 economies. Which ones are the up and coming fastest growing economies, and those were then in their view Brazil, Russia, India, and China. And then a few years later they added South Africa, which is actually a much smaller and less important economy than the others, but it's still one of the biggest economies in Africa. Some people talk about this as a substitute for G7. I think that's been a big discussion this week. Are they doing this to challenge G7? Others look at the new development bank, which is the main organizational part of this, which is kind of an answer to the World Bank and IMF. I just looked for the fun of it when I prepared for this pod. What it says on their own webpage. The BRICS. What is the purpose? And it says, find ways to reform the international financial institutions and create a greater choice and representation for emerging markets. So I found that quite interesting. And I would say the big part, the most important thing of this was in 2014 when they did form the NDB, the New Development Bank, which got capital from these countries. It's also issued bonds in international markets to raise money and use this money not only to as a sort of lender of last resort to support the stability of these countries, but also to lend to them for their economic development. I think it's quite important to have this in mind when we talk about this, because there's been a lot of, I think we haven't seen the latest, information about or communiques from this meeting as we're recording this pod. They will probably come later today, but I've already seen in international media a lot of skepticism, and almost laughing a little bit about the different ideas of this meeting, that they would be able to form a common voice, and their people have said that it's impossible what they're trying to do, and there's a lot of fights between India and China on the issue of adding more members, and the idea of a common currency is completely impossible. So I think it's important to see this in the context of these five countries actually having had meetings, several hundred meetings for over 17 years, and the fact that they can attract, I think it's roughly 60 leaders from emerging markets to meet up for 3 days in South Africa. I personally think that's a pretty big thing.
It's funny when I Googled BRICS news today, the most important thing that came out repeatedly was that Xi Jinping's interpreter got blocked off by a bodyguard. So it seems like that's the biggest focus. But yeah, I think you mentioned about expanding membership, and I can see like Argentina wanting to join this because when it does need a bailout, it always goes to the IMF, and they get harsher and harsher terms. So maybe New Development Bank can give an alternative, and they have better leverage in negotiation. So, what do you think about this expanding the membership?
No, no, of course, that's a big issue here, right? The more countries you have, the less, the less they will have in common in one way, because they will be so different, and the more difficult it will be to make decisions. On the other hand, the more countries you have, which is what China is actually, what China wants BRICS to do, to add more members, and you have some 40 members that have expressed interest to join. Of course, the more they are, the bigger part of the world economy they will be. So it's a balance. I think a couple of countries that would be very interesting and that would add a lot of strength to this bloc would be, of course, Saudi Arabia, as well as Indonesia. If they would join, there would be two quite big economies, and you would then in this block have two of the biggest oil producers in the world joining, and you would also have quite large economies, and together, I think they're already now, without adding new countries, they're standing for some 40% of global GDP, and if they could exceed 50% and get bigger, of course, it's a very important power base, and an important way for these markets to form a counterbalance to the G7 economies. I think another thing I'd like to pick your mind on, Sean, is this idea of a BRICS currency. We talked about that in a previous podcast, right? That it's so central for these countries to actually challenge the US dollar and its dominance, because these countries feel that it makes them vulnerable. It makes them vulnerable to to US monetary policy, to US sanctions, etc. There's been a lot of skepticism in media recently, and it seems like they're not even going to talk too much about any plans to launch a BRICS currency at this meeting. But what are your thoughts? Could that be a reality in the future? A BRICS currency that's pegged to gold, for example?
Before I go into currency, I just want to mention a couple things. So, one, I think it's fantastic that so many countries want to join BRICS. It's a positive sign. Anytime you form something, people want to join. It's a very good line. You have a line outside the door. So it is good. Um, I think the second thing is that when you have something like this, I think any country would want to join because we call this a free option. Like there's no downside. You don't get punished for anything, and you could get something in for joining this. So I think any country would want to join this. And then, so yeah, if we go back to the currency aspect, I think in terms of trade, it does help out, especially if you want to use renminbi more, because usually renminbi is used more in settling trade. And if you're right now you're doing bilateral trade, one country versus another, and if you do that based on renminbi, unless you guys have something to trade with, then you don't have the use for renminbi. So that's why it doesn't work. But if you have a group of countries, then it kind of creates scale, and maybe you don't need something from one BRIC country, but you need something from a different BRIC country, then you can use the renminbi exchangeably. So that is one thing that can happen. And like you said, having like Saudi Arabia, UAE, these oil commodity countries join would be good because yeah, I mean, for like China, that's what it lacks. So if they can trade that in renminbi, it's even better. Um, but I think in the end, there's one chart that I always look at for BRICS, which is you can kind of see how much if BRICS countries excluding China. So how much does Brazil, Russia, India, South Africa trade with each other? And if you look at that for over 20 years, that number has not changed. Less than 2% of their trade is with each other. And even with the formation of BRICS, they're supposed to collaborate, but their trade hasn't increased. The only trade that's increased is how much China trades with the other BRICS countries. That's just continues to be an increasing line. So BRICS, every 5 countries are supposed to get equal maybe votes, but in the end, this is just China and its 4 followers. That's what BRICS is. So I think this needs to kind of change if BRICS is able to grow even further, and then for a BRICS currency to grow. It's just a Chinese renminbi internationalization plan in the end.
And I think now China settles roughly 50% of its trade in renminbi, right? Already.
Yeah, with the trade that it does, yes.
Yeah. I think I read from your answer you didn't say so much about the BRICS. I read you as you are skeptical of the BRICS actually being able in any time soon to launch its own currency. That's how I read you.
Yeah, and it reminds me of ASEAN, which is the group of Southeast Asian nations that's formed. The best thing about ASEAN is that it hasn't broken up, but at the same time, it hasn't done anything. So it's kind of something similar that I see, an analogy.
We'll see. We'll follow this going forward. But interesting, at least, that they managed to see to meet up in South Africa and see what plans they have going forward. We are, I think, approaching the end of this pod. Sean, is there anything else you think we should add, or do you want to make an attempt at summarizing what we've been talking about?
Yeah, I'll just wrap up the main points that we went over. First was on the China macro, especially on the property sector. And I think that the problem will get worse before it gets better. And the government is just doing targeted measures so that the entire economy doesn't collapse. But it still wants to clean up this private development sector. The second was on the currency, that it is more fundamental. So you will get some support from the government, but the trend is for a weaker currency. And we talked a bit about the foreign direct investment, FDI, and the government is sending good signals. But like you said, Frederick, it's about implementation and following up on their words. And then the last one was BRICS, and it's good to have countries waiting in line to join. That'll always generate a bigger influence for BRICS. But I think in the end, there's been a very little implemented and agreed, so that does limit going forward. So that should wrap it up.
Yeah, that's a very good summary. And with that, thanks, Sean, for another interesting discussion.
Thanks, Frederick.
And thanks everyone else for listening in to this pod, the Inside Asia podcast by SEB.